Do you remember the hype around EVs? Yeah, not so much anymore.
As NVIDIA is contributing 33% of the market cap gains of the S&P 500, Tesla is responsible for negative 8%. And sometimes math is just not intuitive that way.
Look at the earnings revisions for the last 12 plus months. They've been terrible.
All that and more. So let's get to it.
Do you remember the hype around EVs? Yeah, not so much anymore. In fact, EVs and AI, they are operating in parallel universes.
That's odd. I thought the Tesla Model Y was the best-selling vehicle last year. I get that AI dominates the water cooler talk, but an electric car was the best-selling vehicle in the year of 2023.
Here's what's happened. The stock price surge that you saw for the likes of Tesla back in 2021. Look at that jump. The likes of Rivian and Lucid also benefiting from all of that enthusiasm. But then the grind lower in share prices. In fact, year to date, Tesla is down about 30%. Lots of question marks, of course, around competition, around demand out of China, around squeezed margins. And talking of margins, look at the revenue split then. The white bar representing Tesla, the orange bar representing the AI chip maker NVIDIA. So Tesla revenues far higher, far greater than those of NVIDIA, and yet they extract far smaller net income, far smaller profits versus NVIDIA. Look at that healthy chunk. When it comes to margins, NVIDIA has margins of around 54% compared to what, 9%? For Tesla?
The difference between NVIDIA's margins and Tesla's margins, besides the fact that one's making automobiles and one is not, is that Tesla has more access to recurring revenue than, say, NVIDIA. And when Tesla solves one of the most important utilizations of artificial general intelligence, Robotaxi, where Kathy Wood and some others see about 80% margins when going to that software as a service model. But it doesn't detract from the fact that Tesla in a decade's time will be the most valuable company on the planet. With that being said, would you rather buy NVIDIA at 2 trillion market cap or Tesla at $500 billion market cap?
Market cap, that's another story. NVIDIA smashing through $2.2 trillion in terms of market cap. Tesla once had a market cap of about $1 trillion. Now it's just a miserly $500 billion or thereabouts. Now NVIDIA is sniffing at the heels of Apple. We don't know if it'll topple Apple. We don't know if it'll get close to Microsoft. In fact, competition is heating up for NVIDIA. That's in the future though. What we know for now is AI is not going anywhere.
Oh! AI is not going anywhere? I guess that means that electric cars are? Well, I guess it's a good thing that Tesla is a leader in real-world AI.
5 of the 7 Magnificent 7 stocks suffered declines last week, with Tesla faring the worst, off about 13.5%, and despite the Mag 7 accounting for around 50% of S&P 500 gains this year, 3 of its members are lagging behind. Tesla, Apple, and Alphabet are all in the red year to date. And once again, you see Tesla leading losses. Yahoo Finance's Jared Blickery, he's over at the big board with more. Hey, Jared.
Such as it is, sometimes we group these stocks together arbitrarily. They might be doing something similar for a limited period of time, and then they get stuck. And here we have the Magnificent 7 with huge dispersion between the contributions, among the contributions to the S&P 500's market cap. You look at NVIDIA over there, it's up $965 billion. And then you take a look at Tesla, down $231 billion. As NVIDIA is contributing 33% of the market cap gains of the S&P 500, Tesla is responsible for negative 8%. And sometimes math is just not intuitive that way.
As we look at this chart, I wonder how many of these companies are actually making automobiles. Oh, Tesla's the only car manufacturer on this list? While the stock market continues to punish the manufacturers of EVs, TSLA will continue to be offered at a discount, and I will continue to buy it.
Tesla is a Magnificent Seven's biggest laggard year to date, but it's not the only one. Shares of Apple and Alphabet are also in the red since the start of the year. Now this week, we are focusing on these 3 laggards and what it's going to take for the companies to turn things around. Today, the focus is Tesla, currently trading just around $179 a share, a loss of nearly 30% this year alone. Our next guest, though, saying that now could be a good buying opportunity. For more on that and what the catalyst will be, we want to bring in George Generikis. He's with Canaccord Genuity's managing director there. George, it's great to see you. So talk to us about why you think Tesla is a buy at these levels.
Well, first, let's address the reason why it's lagged. And it's pretty simple. The numbers have come down. I mean, if you look at the earnings revisions for the last 12 plus months, they've been terrible. I mean, I think we started for 2023 somewhere early in that year on $6, and it came all the way down to $3.
Men lie, women lie, but numbers don't lie. And Wall Street expected those numbers to be significantly higher over the past year. They were not. In order for Tesla to turn around, the street's going to need to see a catalyst that's going to make those numbers spike. Problem is, the street isn't very good at recognizing these catalysts before they happen. I'll continue to load up on TSLA, and when the stock market finally realizes the extreme value that's represented in Tesla, the company, I'll be ready for that massive correction.
And I think we're at a period of time right now where the worries likely exceed the reality. And we had some numbers last week come out of China that weren't very good, but those people didn't take into account that the new year has been pushed into February. Also some, stuff that happened in Germany. Their plant came down for about a week because of arson, a week plus. And in the U.S., people are worried about the production of their new Model 3. And we think that the best way to kind of gauge, for the most part, what's happening with Tesla, particularly in the U.S., is to look at their prices. And they've been pretty stable in the U.S. over the last few months. So, there's a lot of wood to chop still in the quarter, but in the near term, we think that we may have overcorrected here to the downside.
The spending and some of the record R&D that they had done during 2023, which now places a lot of emphasis on bringing that to fruition in 2024 and years following now. How much of that spending do you anticipate will lean further towards the side of this artificial intelligence narrative that has started to prevail with Tesla, even though we've seen some early slippage this year, at least in the price action?
We're in a little bit of a pause period right now for the stock. In the near term wiggles, we think we've overcorrected, but for the stock to really get its legs, we have to have three things happen. First, the next generation vehicle has to start to ramp, or people have to gain confidence that it's going to ramp and be successful. Second, their margins need to go up, and the most likely lever for that happening is the increase of FSD, full self-driving penetration, which leverages the AI that they've built.
Ding, 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 ding! Tell him what he's won, Johnny. Your mother right. That deferred revenue from FSD, I'm sure, has been looked over by many an analyst. Given that the hardware is on every single vehicle that they make, the adoption of FSD will become pure profit margin. 12 grand per car? I'm no mathematician, but I know that's a big increase to the margins.
In addition to volumes starting to pick back up. And third, it's continuation in growth, really good growth in their energy storage business. So when you talk about leveraging this R&D that they've spent a lot on, it's two real products that come out of that, the big spending. It's number one, that next generation vehicle, which we think should start production in the second half of 2025, and continued FSD penetration. Now, we think that the FSD offering from the company at $12,000 currently is a little too rich, particularly relative to the cost of the vehicle. We think the company should cut the price of that FSD to really increase penetration and really have the margins start to turn in. If you think about it, that offering is about 100% gross margin, very, very high gross margin because it's a software upgrade.
In a way, George is right. An incremental decrease in the price of FSD would generate an exponential adoption rate. But the value of FSD, even in its beta form, I think the juice is worth the squeeze. It's definitely worth the squeeze once they solve for autonomy. In fact, it's probably a bargain. 12 grand in your car is essentially an autonomous taxi. You would increase the value of your vehicle threefold.
George, we have seen, though, the price wars play out. Obviously, Tesla, far from the only automaker, one of many, I should say, that has been forced to lower the prices, obviously putting pressures on margins, very similar to what you were just saying. How do you see that, more broadly speaking, beyond Tesla, shaking out just a bit, and that pressure to the downside in terms of boosting demand? How much longer are they going to be forced to slash prices in order to drive the demand that we simply have not seen?
Well, look, there's been a pause, like I said, recently, particularly in the U.S. The price declines that we saw for the most part in 2023 is sort of ebbed right now, which for us is an indication that maybe things aren't that bad. And what the company did strategically by being that aggressive is, first of all, they get to sell more vehicles, right? Because interest rates went up and most people financed the purchase of their vehicles. So that meant that the prices of vehicles went up artificially. But second, it put a lot of their competitors on their back legs. I mean, margins got a lot worse for some of the pure play EV competitors. Sales got a lot worse for them. And even for the traditional OEMs that try to compete against Tesla, their margins got significantly worse because they couldn't compete with Tesla on price. So what we saw is, longer term, what Tesla did is put a lot of its competition on the back foot, particularly in the United States and Europe.
Price cuts will continue to happen as long as there's more of the total addressable market to be gained. The vast majority of consumers are buying internal combustion engines. How do you dissuade them from doing that? By offering a better product at a lower price. The cost to manufacture battery electric vehicles is predictably going to come down the more that you make them. Companies that don't have negative profit margins, I think Tesla's the only one in the US, can then pass on those cost savings to their consumers and still maintain industry-leading margins.
We see the real competition for Tesla long term. Like, we really like Rivian in the United States and in parts of Europe and other parts of North America. But in China specifically, there's some very, very good OEM competitors, some pure play EV companies. The company has one plant in China right now, able to produce about 950,000 vehicles. And they're running, despite this monthly volatility, they're running full tilt there. And we continue to believe they'll run full tilt in that country.
Giga Shanghai, Tesla's main export hub, you best believe they're running full tilt, selling everywhere, including Canada from that factory. And while the competition may be stiff in China, the real competition is the internal combustion engine. And there is so much of that market share that is left to be eaten up. In conclusion, Tesla is the biggest laggard of the Mag 7. I'm not even sure if it deserves to be in the Magnificent 7. I mean, those other companies are great, but Tesla's going to be the most valuable company in a decade's time. So much, in fact, that comparing them will be ridiculous. Tesla is in a class all by itself. It is the Lone Ranger. It is the Han Solo of the stock market. An anti-hero that doesn't play by the establishment's rules. And yeah, the stock has been punished for the year of 2024. That is to be expected. Not everybody understands the value of this company yet. But if you believe like I do, and you think that Tesla's going to be selling over 15 million plus cars per year, in addition to all of the other things that they've got going on, I'm perfectly fine with the misunderstanding of TSLA. It gives me more of an opportunity to put as much money in the stock as I possibly can. That's all I got for you today. Be easy. Bird.